Okay, so welcome to the usual Friday. This recording, right? Just want to tell you guys first that it will be posted as a public video lah. Okay, because you usually this kind of recording I don't really post out into public, but for today I will be doing that because there are a few things I'm gonna discuss, which I think is good that everyone knows also lah, aside from like just us lah. Okay, but I mean we will not go too deep into a lot of stuff also. So yes, we have the CPI week, and the CPI turns out to be quite good in the sense that it is like going down. It is way below the expectation, and not only that, it is one of the biggest drop from 9.1 back to 8.5, because I believe previously it was from 8.5 to 9.1, if I'm not wrong. It was a 0.6 jump. No, it was 8.6 to 9.1, and then we are now back to 8.5 again. So I think because of that, market just rally all the way. In fact, like that minute where the number came out, you can see this one big green candle here coming out. Okay, so there are I mean we are walking on a very fine line here. So on the bright side, we are no longer overloaded with shorts except for Plug Power, but that was a very speculative earning place lah. But aside from that, any shorts you have will probably be those that you are holding from like quite some time back lah. Okay, but when Joe Biden was making the announcement, I actually had a shock, mainly because he was saying that we have 0% inflation. We have 0% inflation, and then if we have a 0% inflation, right, you should straight away short the market already because we are in a deflation mode lah. But I believe what he is talking, what he's referring to is the CPI month over month. I think is this one, CPI month over month. So from previous month, the inflation didn't grow. The inflation did not grow from previous month. Okay, so I believe that is what he was talking about. So normally in a situation like this, right, what we are facing right now is kind of like in a, I would say like a transition zone. Transition zone, I don't really mean in terms of the economical perspective, but before we get into that, right, let's talk about the CPI data for now lah. So I don't really want to dive so much in depth into the CPI data also, but one thing to highlight is that the major cause of the CPI dropping is due to the gas prices lah. The gas prices was one of the major factor. You can actually go and see, but just to quickly show you, you can see that over for majority of the month for this year, right, the energy portion, right, it has always been the biggest jump. Like in March, right, you have 11, 18, 18. Then in April, it contracts a bit. And June, it went up so high. And then in July, it contracts back down a bit, negative. But aside from that, right, most of the other section are still like, I would say the inflation is still going up, and the energy portion was the major factor lah. But regardless for whatever causing the inflation to come down, right, we have the stock market reacting positively on the day itself, which is like that's all we need to know lah. Okay, so because of that, right, what I like to do is like I will sit down and look at my trade plan a bit. I will try to do some troubleshooting, looking back, and do a little bit of reflection also lah, to see what could have been done better and what to do, like how should we plan continue going forward. If you have not looked at the market update, right, do look at it. It was posted on 11 August, which was yesterday lah. Okay, so do take a look at it, and I have a case study which I compared the current market to 2018 December. So just to briefly go through this, right, if you have not really looked at it, or if you look ready but you have no idea what's going on, just to do like a very quick summary, right, in 2018 December, around this period, we have a so-called market bottom, and after that, the stock market just rally all the way up. Okay. So during this period, right, the federal fund rate was at the highest level. It was at 2.5 level. Sorry. It was actually here, somewhere here. So even though you may think that this period is like a very short period, right? Actually, it is not. So it remained at this level from like December 2018 all the way until like August 2019. Okay, so this area actually lasted about 7-8 months like that. But when the market bottom in December 2018, right? It was actually when the hype peaked. The hype actually peaked and the market kind of like rally all the way. So why did the market rally back then it's the same reason as it is right now. The market is rallying with the expectation that sooner or later, the rate hike will start to ease. The Federal Reserve will pivot. So that's why the market rally back then. But the difference here between then and now is that back then, right, the inflation was actually at 1.9%. 1.9% is actually below the Federal Reserve mandate of, I believe is 2%. Yeah, the Federal Reserve mandate is actually 2%. But back then, the inflation was at 1.9%. So Federal Reserve actually can like lower the interest rate to boost the economy. At the same time, they are also meeting their interest rate mandate. And they are also sort of like relieving the pain on the financial market, which is the stock market itself. So because of that, back then, like it is logical for the market to assume that sooner or later the Federal Reserve is going to ease. And actually during this period, right, it was very doom and gloom also, like what we are seeing right now, like, oh my God, the market gonna crash, then there's a lot of trade war, there's a lot of tariff, or a lot of US versus China stuff going on. It was during the Trump era period. Okay, I do remember trading here back then, but at that time I wasn't really trading US stock. I did trade the index, but I wasn't really trading US stock. So when the rally happened here also, back then I didn't really catch the bottom right here, but it was somewhere around here because like this period everything was so doom and gloom and we don't really know what's going on back then also back in hindsight. Okay. But if you look at the case study that I posted, right, actually as early as December 2018, right, Federal Reserve actually came out and state their intention to sort of ease the rate hike or actually decrease the rate hike through the SCP, this summary of economic projection where let me maximize it. Okay, so on 19 December 18, right, Federal Reserve posts this report, and in their Federal Reserve federal fund rate projection, right, they stated that they are going to reduce. They are going to reduce already. Initially, the projection was 3.1 for 2019, but now they reduce it down to 2.9. So you can go and find this report itself. And then on 20 March 2019, it was further reduced again from 3.1 to 2.6. So this is the projection. This is what they project for that particular year. They haven't really reduced the rate yet. Eventually, they reduced the rate in 2019 July. So when they did the actual rate reduction, it was like somewhere here, July, somewhere here. August, sorry, not July. It was somewhere here. It was somewhere here after the market did a crash here, but the market is already rallying here. Okay. So that is the similarity between back then and now. But the biggest difference is that back then the economy was in quite a bad state, and it does make sense for Federal Reserve to reduce the rates to sort of boost the current market a bit. And considering that back then the inflation was 1.9%, which is like so much different from what we have right now currently, even with the Wednesday CPI data reading, right, we are still at 8.5%. So back then, right, Federal Reserve projected that they are going to reduce the rate. They haven't reduced the rate, they have projected. But the stock market moved first. So the stock market is moving one step ahead before the actual rate hike, before the actual rate easing happened. But Federal Reserve already made that intention really. But here, right, we have the market moving 2 steps ahead. The market is moving in anticipation that Federal Reserve will reduce their projection, because right now Federal Reserve haven't reduced their projection yet. In fact, the latest projection was very, very high. It was actually quite a big jump. Okay, so this is the latest projection, and you can see that in the latest projection, right, the rate was from 2.8 to become 3.8. So it is a very big increment. Okay, so this is the latest data that we have, but market is moving ahead. So market is moving ahead of the projection. Previously, the market was moving together with the projection. So now market is like 2 steps ahead. Previously, they were only 1 step ahead. Okay, which is why, right? Which is why it is very dangerous. It is still very dangerous, and even though we cannot be fighting against the price action that we see here, which is definitely bullish, which is what the market is in agreement, right? But we also cannot fight the Federal Reserve, which is which is the current thing that is going on. Just now you have seen in the Bloomberg already. Why is the market fighting Federal Reserve? Because time and time again, right? Both Jerome Powell and a lot of FOMC members came out and said that they are still gonna increase the rate. They are not gonna reduce it. They are going to stick to their mandate of bringing inflation down to 2%. So even during the last FOMC meeting, that statement has been made over and over and over. So the market is moving with the anticipation that the inflation is coming down, and Federal Reserve sooner or later they are going to ease the rate hike. So that is what we have right now. Okay, so because of that, right, it is quite dangerous. It is quite dangerous, and you can see that even with the yesterday so-called the shooting star candle, right? The futures is just recovering here. So as a trader, right, even though we maintain certain view, we have certain bias. For example, if you still ask me right now, I will say that I am still bearish. I still believe that things can go down. But the key thing here is we cannot fight the price action. We cannot go against the price action and keep like banging ourselves against the wall and then end up losing trades after trades after trades. Okay, so that's one thing that we shouldn't do. But there are a few things that we can do to make sure that we are able to sort of maneuver ourselves in a way that we will eventually be in the right direction. Okay, so firstly, let's look at the journey we have so far in 2022. So currently put yourself in my position here. During the earlier part of the year, we hit some losses. Then after that, we were able to project the market direction accurately, and then we were able to get some profit. But eventually, we were cut off. We run into a little bit of drawdown here also. But at this time, right now, I am probably sitting on a annual return about this year return about maybe 15 to 18%. The last time I checked was around 18% like that. So with that amount, right? With that amount, I am sitting here in a neutral position. With most of the position cut off already, right? I am now looking at this from a neutral position to see what I can do. But even though the neutral position, right, I am referring to my portfolio. Okay, my view is still bearish, but my portfolio is neutral. So now think of it from someone who is a bull, who have been waiting to buy, who is waiting for market to recover, right? So most likely there will be a few kinds of bull, because I don't believe that there are majority of the trader out there actively short. Most of the time they are 100% long position. There are a few traders out there who short, but not the majority. Okay, so given that direction, right, if we look at the bulls, there are probably a few kinds of bull. The first kind of bulls is those who are stuck from the beginning here, okay. So when the market suddenly like recover like this, right, most likely is that they are seeing most of their position recover greatly. For example, if you are on those counters like Apple, Amazon, these are the two big counters that recover quite significantly lah. But I will not say so much for the Cathie Wood counter, even though the Cathie Wood counters are recovering like extremely like aggressively, right? For example, we have Coinbase that went all the way up by 50% like that. Shit. Yeah. We have Coinbase that went up close to 100% like that. But I mean, if you have Coinbase back in like even March, April, right, this 50% is not gonna do anything now, okay? So in terms of the return wise, all these for example, the trade desk also went up so much. But I think this is slightly different lah. If you have this counter back here, then you are probably break even lah. But what I am trying to say is that if you are a bull, right, most likely you are not in a profitable state, but rather you will be in that break-even state where you are slightly more encouraged right now to participate in the market again, because now all your rates suddenly become less red or maybe a little bit of green here and there lah. But most likely for the first half of 2022, right, you probably will have been like sitting around not doing anything lah. And there are another kind of bull where like more of the short-term bull, where you'll probably like lose money, and then you make a lot of money here because you correctly bottom pick. And most likely you are probably at the break-even rate also, depending on how much you lost in the earlier part of the year lah. So from both the bull position and my position, right, there are a few actions that we can take here at this junction. But you have to understand, we have to account for risk also. We cannot just blindly do anything. So okay, so the first option that we have, we can do is that for both bulls and the bear, right, you can like expect this trend to continue to sort of go up very aggressively. Like even for me, right, since I only have like 3 positions open right now, what I can do is that I can immediately fill my portfolio up with about like another 6 long position lah. Okay, then perhaps my portfolio now I will have like 9 long position. I can go for a 180-degree U-turn lah, from a bear become a bull lah. But even for myself and the bulls, right, it is very dangerous because as mentioned, right, the fundamental in which this rally is happening, right, it is very shaky. Not only is very shaky, right, even if everything is intact, even if the whole fundamental is like sound, this rally is a little bit overdone also. So I do believe like even if the uptrend were to remain intact, right, there will be a pullback. The pullback can be maybe like this, or it can also be like this. So I mean, I'm not sure when the pullback will come, but there will be a pullback. And if you go and long in this, like if you go and chase the long in this current state right now, right, what you're actually risking is you might actually risk into a pullback. So if you are a bull who just like kind of like break even right now, and then you go and like put more position into your portfolio, right? And then when suddenly the pullback happen, right, you will be kind of like a little bit shaken. You'll be like, hey, oh my god, now I got more position on my portfolio ready. So if the market U-turn, most likely those positions that you are holding earlier, which break even right now, they will become losses. And whatever position that you add on some more, it will become even more losses also. So you are now faced with that situation. So even for a bear like me also, if I suddenly 180-degree go and change into long, right, I can also suffer that position where like the moment I U-turn into a bull, right, everything come down, and then now all my long position get cut off also. But as a bear, right, I can also do another thing. I have another choice also, which is to be very dogmatic with my view. I just like ignore the price action. I can go and like, okay, I still believe things are going to fall down further. I will just pile in my shorts. So I call that the Michael Burry mode lah. Is it Michael Burry, the big shot guy? The one who predicted the housing market. Yeah, I think it's Michael Burry. Shit, I can't even remember his name. Yeah, I mean I can go with the Michael Burry mode and then I can keep piling and piling and piling. And then eventually when that big drop come, right, I'm gonna profit like very, very big. So it's like your risk is super high, your reward is super high also. I can definitely go into that mode, but the thing is that kind of move, right, is very tricky. As a retailer, is very tricky to perform because you do require a lot of conviction, and you truly need to trust your data and your whatever analysis that you are making, okay. And the thing is that yeah, and definitely holding power, correct. Your capital must be there, okay. If your capital is not there, for example, right, you go and pile in all your shorts here some more, and then market continue to rally, and then after that you give up, and then after that this whole thing drop down, and then like you got your direction right, but your timing is wrong lah. So you are a broken clock lah, okay. And I can tell you that as early as here, right, as early as September, there are already a lot of talks about inflation is gonna come, and then there will be Federal Reserve hiking, and then the market is gonna crash. And when the market actually dropped here, right, there were a lot of bears who got caught, There are actually a lot of bears who got caught here because they were like, oh my God, like what we predict is actually happening. After that, they got caught on the upside here. But eventually, their analysis were correct. It is just that they were a little bit early, okay. So going back to here, right, even as a bull, you want to ensure that you don't fall into this position where you're like, yes, maybe your direction is actually correct, but we might have another shakeout before the actual rally can happen also. So in both cases, right, both bear and the bull, you do have to be a little bit careful on how you are treading the water here. So back to my current position, right, because I have already sort of like got 18% return for the first half of the year, I can actually make the Michael Burry move, because what I can do is I can just risk the entire 18% that I have. So for example, right, like for the first half of the year, I have made about 30K in profit. So I can risk that entire 30K and put a one big shot here with a 30K risk. So if let's say my trade pays off, right, then I can probably turn this 30K to like become 60K, or even become like 100K like that. Like if I'm trying to use option leverage whatever or if I keep piling onto my shorts even more, it is definitely possible. But let's say if I'm wrong, right, then my 30K is gone, and then like for the entire year my return is 0%. But the key thing here is because if you have already profited quite a bit in the earlier, right, then you got that buffer, to play around with. But let's say if you are a bull who just broke even here, right, you don't really have that kind of buffer to make that kind of risky play where you just pile in a lot of long position hoping for another rally upwards. You don't really have that kind of playing power also. And as a bull, right, if you are holding a lot of long position that just break even, right, it is highly unlikely that you are gonna like suddenly short here also while still holding a lot of your long position. It just doesn't make sense from a retail trader perspective, okay. So like that, because of that, right, most bulls will not really short unless you are familiar with the long short equity strategy, those kind of stuff, okay. So that shorting option is really detached from the bull so-called the strategy list already. So because of that, right, we don't want to pile in everything yet. We are moving very carefully. We are treading very lightly. We just want to add one long, add one short, and then like we have like maybe a 2 long, 2 short position for a while right now, and then we see how the market goes, and then from there we can make we can adjust to whatever direction that the market is heading towards lah. And from the long and the short position, right? We can actually still make money even if you have too long, too short, provided that your long outperform your shorts lah. For example, right? Let's say the market becomes super bull. Okay, the market becomes super bull. As long as your long is going up more than your shorts, right? You will still make money. Or the market suddenly jump all the way down, as long as your short is dropping more than your long, right? You will still make money lah. But what it allows you to do is it will allow you to let go of your long position, and then if let's say the market continue to go down, right? You can release your long position and add more short position, so you are lumping onto your profits lah. In the same way, if the market is going up, right, you can sort of like prematurely let go of your short position and add more to your long position, and that is where we are able to pivot nicely lah. Which is something that if you are trading index, right, most likely you will not be able to do, because what are you going to do? You want to long S&P and then short S&P, and then you are like stuck there already. But if you have if you are playing stock, right, what you have is the stock that outperform will give you the profit lah. So it becomes like you have to choose which stock is going to outperform which stock lah. Okay, so that's currently the basic situation that we are in right now. So I was looking back on this period also to see if there are any mistake that I have done, and if anything that I should have done, and like I mean, to ensure that in the future, right, we don't make the same kind of mistake also. There are good things and bad things that I believe I have done. So let's just go through. Okay, so firstly, let's point out the things that we shouldn't have done lah. Firstly is the 14 July inflation report, the 13 July, 14 July lah. Okay, so this is the time where the inflation came out, 13 July, 9.1%. So when that came out, right, you can definitely see from the chart, market actually went down first, then after that it recovers. So during this period, right, I believe that it is correct not to go bull during this period. I think that is still a fine decision, but after the market shows that it actually broke out of this resistance, right? I do believe that during this period, there was something that should have been done lah. And I'm not talking about like a hindsight where, okay, like, oh, this one go up and then consolidation breakout, then here, right, I should have just exit all my shorts and then like buy all the Apple long position with CFD, and then now I definitely be a millionaire already. I'm not talking about those kind of stuff, because if let's say if you were to remove all your shorts and go into long position just because there's a technical breakout here, right? Then you are still open to a very big risk. You are still open to a very big risk, because when you do this kind of reflection, right, you have to ensure that you don't do it on a hindsight basis lah. Okay, you have to pretend that back then you don't really have certain information yet. So for example, if I were to look at it here, right, I mean, we didn't really know it will go up further like this also lah. But what could have been done here is that, number one, right, we have realized that the stock market is actually responding in a very different manner to the CPI data release. So back then, right, at this point, we should have put some long position to protect ourselves lah. And the risk that I'm talking about is that this is 19th of July. 1 week later, right? 1 week later, we actually have FOMC meeting. So if you decide to exit all your short and go full long, right, you are still open to the risk of the FOMC meeting, where it is definitely possible that it can just, like, the market can just come down like that also, definitely possible. But of course, right now we know that it didn't happen lah. But regardless, right, during this period, it would have been better that we have 1 or 2 long position, and we actually do have them. We do have Calmain, but we did not have Wingstop. During that period, we do not have Wingstop, which is something that we shortlisted lah. And I think another mistake was that back then, during this period, we we piled additional 2 more shorts, I believe, which was Tesla. I can't remember the other one, but I remember Tesla because I made a loss on that trade. So that's why I very clearly remember Tesla. Okay. So let's say during this period, instead of like 5 shorts and 1 long, right? If we have 4 shorts and 2 long, it will be easier to pivot. It will be easier to pivot in the sense that when that 4 shorts is cut off, right? We can easily add 1 or 2 more long here, and we can easily ride the market in a much better state lah. But because we did not really have any long position back then, that the transition was a little bit hard to make lah. And the trigger for that protection, right? There were two triggers to signal you to go into the protection mode, and those triggers were: number one, stock market was reacting quite strangely into the very high CPI. And then we also have a FOMC that is coming up. So previously, during back then here, right, we did have protection going into FOMC mode lah. Okay, so I think that was the mistake that was made. But also on the, I mean, we can't really keep talking about mistake. Also, I believe that even though that mistake was made, right, going forward, the good thing is that we did not pile in any more aggressive short. Home Depot was, I believe Home Depot was ad hoc trade, meaning those who are already holding Home Depot, right? They are already holding lah. Yeah, I think it's CTRA, correct? I think it was CTRA. I think you are right. Yeah, I think it was CTRA. Yeah, thanks for the reminder. Yeah, so the good thing that we did was, okay, we already made that mistake here, but after that, right, we did not pile any more shorts in. We have 1 Tyson shorts here, which was a earning play, and we managed to get profit on that. But I mean, when I say piling in more shorts, right, we are not like banging against the wall where, okay, I have took a loss on 4 shorts straight. Now I'm gonna add another 4 more shorts because I think everything is going down. The market is irrational, whatever. So just like revenge trade lah. Okay, so we didn't really do that, and I think that is something that I would say it is a little bit hard to appreciate because it doesn't really shows up on your trade journal or whatever loss that you prevented because you didn't overtrade lah. So these are the kind of data that doesn't really shows up on your trade journal lah. So it is quite common where when traders run into this kind of situation, right, especially drawdown, okay, especially drawdown situation where you suddenly you are faced with 3 or 4 losses, and suddenly, right, whatever you think you have analyzed like have been proven wrong. So in those kind of situation, right, you can suddenly become very tilted in the sense that just like rage lah, okay, like super rage, like for those who are familiar with video games, right? Like you play against another player and then they keep killing you, and then you become super angry, super rage, and then which affect your performance even worse lah. Now you keep losing even more lah. Okay, so it's easy for trader to become very tilted in this kind of situation, and you can actually compound onto your mistake and then make even more losses lah. And in this case, right, unlike video games, in trading, you are gonna lose a lot more lah, if you keep banging your head onto the wall. So I think during this period, right, even though we sort of we were not in the long position to get the profit, but I do believe that even with a very strong bearish view, we were able to sort of not go into any more shorts and then just stand back lah. So between here and here, right, there were 2 days where market went up the highest. One of them is the Federal Reserve Day, which is the FOMC day, and of course the CPI day. So the worst thing as a trader, right, is that you can be extremely dogmatic in your view. It's like you truly believe that what you think is correct, like you are very bearish, the market is gonna make make another crash, and then what you might end up doing is, okay, I think during this day the CPI is confirmed going to be bad, market is going to be crash, there is resistance here, and at the same time you feel the need to win back all the money that you have lost, and then you go and place one very big shots here, and then you can get caught in this situation lah. Okay, so that's the kind of mistake that we don't really want to make, especially when we already have a drawdown back then. So that is why during this period, right, it is good to lay low for a while, especially if you already make some form of profit in the beginning part of the year, right? You do want to protect that profit, because currently, yes, market rally is a little bit irrational, but we don't want to fight against the price action, and we want to position ourselves in a way where we are a little bit more neutral, so that wherever the bigger trend takes us, right, we will able to reposition in the future. So in this case, right, this rally can definitely pop. There's a chance that this rally can pop and it will just go down further. But the thing is, from now, right, from today onwards, there aren't any really, I would say, data that is coming out that can drive the market lower. Towards the end of July, towards the end of August, we may have the PCE data, the inflation that Federal Reserve look at. And then, of course, in September, we have another CPI data before the FOMC meeting. So let me go and check. Let me check when is the September. It's actually on the 20 and 21st. So 20 and 21st is after September CPI data. Okay. So it's still quite far away. It's still like one month from now. So during that month, right, most likely market might continue to go up a bit or sideways a bit, like we don't really know. And I don't believe the PCE data will crash the market also lah. But who knows? Don't want to count the eggs too early lah. Okay, but what I'm trying to say is that if you were a bear and you believe that the market is going to crash, the catalyst for this month is over lah, and the market did not crash lah. Okay, so the market will most likely will be still on this trajectory, but the thing is that it is a little bit overextended. So if you are trying to squeeze in one long trade so that like you can catch something before it hits all the way up, right, it is a little bit dangerous also. Okay, I mean one long trade is fine, but I mean you do not want to pile your entire portfolio with like 8 long position hoping that it can go up further lah, because maybe it might not hit your TP, maybe like it just goes sideways, and then when September things start to the data start to come out, right, then you might face a big crash there lah. Okay, so do be mindful of that. And in September, right, there is going to be a summary of economic projection also. So we will see this data again. And this one is very important because we will be able to see if the Federal Reserve is going to increase their projection or decrease their projection. And that is very important because if Federal Reserve increase their projection, right, then I think the market definitely gonna dive. It is mainly because now the market is rallying in anticipation of decreasing projection. So decreasing projection, not actual decrease in the rate hike. Okay. So, but if let's say the projection remain like stagnant, it doesn't change, I still believe that the market can continue to go, the market can still go down because the rally is slightly overextended already. Okay, so that September report is very important. So this is still my bearish view. Okay, you have to understand this is still my bearish view, but because of the current state of the market right now, I don't really want to like pile a lot of shots right now. So we want to maintain the neutral state for now, so that we are not caught in this extended rally lah. Okay, because as mentioned, right, this kind of rally, there's a lot of short covering taking place. And recently there was a article that came out. I forgot which bank, but I merely just caught the title that saying the institutional funds are net long right now. whatever that means, because I mean they can be net long, net short. I mean back here a lot of funds were net long also lah. But I mean just pointing out lah. And yeah, so back to this, right? This one is quite important. So we do want to see what is going on here lah. Okay, so just to show you the 2018 one, now you can go and read all this in your spare time. I think these are very good data that you can look at and then you try to see how the market is being affected. Because right, currently in this current economic situation, the level of debt compared to the GDP growth, right? So remember previously we talked about GDP growth and how it affects the stock market. So usually when the GDP is projected to be positive, right? The stock market tends to be positive in that particular quarter. In that particular quarter also lah. Okay, so that relationship is like I would say most of the time it is true. About 70-80% of the time that relationship is true. There will be a few outlier situation where, for example, right, the market simply rally too high, and then for that month there is just some profit taking happening, and then the S&P dive by maybe 10% like that, which is a normal so-called a normal retracement. But for that particular quarter, GDP went up. So in those situations, you have those rare moments where the S&P is negative but GDP is positive lah. But aside from that, right, most of the time GDP up, S&P up, GDP down, S&P down lah. Okay, and in this current economic situation, right, what you have is that the amount of debt, the amount of M2 money supply, the amount of debt that the US economy is holding, right, compared to the GDP, it is like way over bloated compared to say back in 1980s or 1970 lah. Okay, so because of this extremely high level of debt, right, the stock market is very sensitive to interest rate because the debt is now so much higher per GDP compared to how it was previously lah. So it is good to look at all these FOMC meeting and whatever that they are trying to say. And the funny thing is that the Federal Reserve, right, sometimes they don't really agree on certain things among themselves. Sometimes they like flip prata also. Like for example, right now, right? Right now, the Federal Reserve is saying yes, we are going to stick to 2% inflation target. We will definitely keep hiking, but the market doesn't believe the Federal Reserve, which is why you saw the Bloomberg guy saying do not fight the Federal Reserve. The market is calling Federal Reserve bluff because the market believes that, okay, we don't believe that you will continue to do aggressive hike. So we have this kind of relationship going on, mainly because Federal Reserve have been very flip-flop in the back, like back in the past, because there were a lot of cases where they say they want to do quantitative tightening, they want to increase, like back in 2015 they want to increase the rate hike. And in fact, right, back then they wanted to increase the rate hike until let me see, who is this anonymous rhino. Back then, right, let me show you December. Okay, you see back in December, this is 2018. Okay, back in 2018 September, they want to increase 2018 to 2.4. Yeah, correct, 2.4 lah. Okay, they want to increase to 2.4, and then in 2019, right, they want to increase to 2.9. But the thing is that back then they only increased to 2.4. They only increased to 2.4. It never hit 2.9 because subsequently they project it down because of how bad was the economic situation back then. Okay, so back then most likely when market fell this low, right, it was already pricing in a 2.9. It was probably already pricing in a 2.9, or maybe it was pricing in a 3.1. But the moment they start to project it downwards, right, it recover quite aggressively lah. So going back here, right, let me just show you, okay? So this is 2018, this is 2018 FOMC meeting. We can look at the September one. We can look at the September data. And in September data, you can see that this is 2.4, 2.4, 3.1, no change. So imagine yourself back in September 26, 2018, and you are looking at this report. There is no change at all, no change at all, no change in the projection at all. And let's look at back then. September is somewhere here, okay? September is somewhere here. Somewhere here, okay? So when you see that, right, you will realize that, actually the Federal Reserve is they don't have any intention to ease the hype or whatever lah. And then you will start to see the market start to respond, and then the market start to drop all the way down. And then somewhere around December 18, right, you start to see the on December, you will start to see something changed. Now they are revising downwards. Now they are revising downwards already. And that is where you will see there's a change in the market sentiment. Okay, but of course, I mean back then, the price is still heading downwards. So I mean, it is, you are not going to use this as a entry signal. Okay, you are not going to use all these things as an entry signal. But at least you know that, okay, if market is going to go up, at least you will know the reason. So probably maybe by here, you will probably realize that, I think market is going up because finally it is responding to whatever that they are saying here right now. So what you can actually do is you can go and Google things like, why did market crash in December 2018? And then you go and Google, why did market recover in 2019? And then you take note of those date, and then those articles came out, and you will be able to see that it kind of like coincide with the report that you are seeing here. It will definitely tell you a lot of provide you with a lot of information. But because of the history where the Federal Reserve always come to the market rescue, right? I believe that is the reason why right now the market is kind of like rallying ahead of the projection. In the past, market rally ahead of the actual pivot, but now market is rallying ahead of the projection. So it is a little bit very I would say the market is being too smart, okay? And because of that, right, because it tends to do things ahead, you will tend to see like very big swings. You will tend to see very big swing, especially during the bear market, because anytime the market feels like it's gonna recover, right, it will do a big rally up. But after it realized that it made a mistake, it will do a big rally down, and then you will see a very big swing. Whereas in a bull market, you don't really see that big swing, because like generally market like to stay in the bullish mode. The bull mode is the default state. Okay, let's go look at some of the trades that we have. Okay, it's good that Spotify is recovering a bit from yesterday. Plug Power is kind of like came back down. It kind of like surviving a bit. So now we have Plug Power and Spotify, right? Plug Power is a short, Spotify is a long. So these two, they are like together. They are the spread trade that we talked about during our previous webinar. So what you will often see is that when they go up, right? When they go up, most likely we hope to see Spotify go up more than Plug Power. Or when things start to go down, right? We hope to see Plug Power go down more than Spotify. But you will notice that Plug Power actually have a very high beta. It swing a lot more compared to Spotify. So in this case, right, what most likely the state where you will most likely be able to profit is when the market go down. most likely when the market go down, right, plug power is going to go down a lot more compared to your Spotify. And if we start to see that, right, what we can do is, let's say somewhere around here, if plug power went down somewhere around here, right, we can actually like see how much did Spotify go down, and we can prematurely exit our Spotify with a very small loss, and then we can hold on to plug power and it will go down further some more lah. So that is the kind of play that you can make. But let's say if plug power continue to go up, right? So this is a little bit more advanced, because if you have a pair trade like that, right? Actually, what happened is that it removed the need for you to have a stop loss, which is very, I would say it goes against everything lah. But you do have to be very careful on how to manage it, because as mentioned, right, it is slightly more advanced, mainly because let's say if plug power goes up, most likely your Spotify is going to go up as well, meaning your profit from Spotify is helping you tank your plug power a bit. And then because of that, right, even if plug power hit the stop loss, right, you can still continue to hold plug power as long as Spotify is continue to go up. And eventually, right, if Spotify went up high enough, right, then you can actually like cut off your plug power lah. So what you will have is that the difference, your profit or loss, right, it will be the difference between your plug power and Spotify. So what you have to monitor is you have to monitor the so-called the floating loss lah. Okay, you still need a stop loss, but you monitor it in terms of your floating loss. For example, right, let's say I have two positions here. I have plug power and Spotify. So for plug power, my stop, I am risking $2,000. Okay, I'm risking $2,000. Based on a 150K portfolio lah. Okay, so it will be probably about 1.5%. And then on Spotify, I am also risking $2,000. So what I have is I have a $4,000 risk on these two positions. So if let's say both counter continues to go up, what I can do is, as long as my floating profit, my floating loss doesn't exceed $4,000 for these two positions, right, I can continue to hold regardless of how high the price is going. And then because of that, right, at some point, for example, if you believe that the market is very bearish, or you believe that market can U-turn soon, right, you can actually hold on to this position beyond your stop loss. And if let's say the market start to U-turn or what, right, then you can actually let go of one and hold on to the other lah. So by doing that, right, you actually remove the need to have a stop loss just by looking at the floating profit and loss of these two counters lah. But I mean, this is just an example, because right now the situation we have right now is for plug power, right, our entry is actually here because the trade came out here, but on this day, right, the price gap down, so my entry is somewhere here. Okay, so because of that, right, currently my plug power is already in quite a big I would say in quite a big paper loss lah. But I only entered Spotify yesterday. Okay, I only entered Spotify yesterday, which means to say that plug power is already losing quite a substantial sum ahead lah. So in this case, right, you have to do a little bit of due diligence on see whether you want to continue to hold or not, because actually plug power stop loss is at 30 lah, which is quite near. So maybe in an exact example like this case, right, it might not be wise to hold plug power beyond the stop loss, but it is just an example. We will be able to make more such a spread trade in the future, where I mean the starting difference isn't the gap isn't so wide lah. Okay, but because this is the only running trade that I have right now, so I am sharing this with you lah. So what what we have here is that regardless the market go up or go down, right, you will not see your profit and loss between these two trades affected by the market, mainly because if the market go up, these two will go up, market go down, these two will go down lah. But your profit and loss will come from the fact that whether if plug power is a weaker counter or the Spotify is the weaker counter. So for example, if let's say here plug power short, Spotify is long, but let's say plug power is a stronger counter where it just shoots all the way up while Spotify chose to remain stagnant, then most likely this trade will incur a loss also lah. Okay, so it is not like a magical solution or what, but in a market situation where you don't really know where is the broad direction, right? You can remove the market risk by doing a long and a short at the same time lah. So there are other longs that I am looking at also, but as mentioned earlier, I don't really want to rush into all the long position so fast, mainly because of it is a little bit overextended lah. So in this case, right, I will want to see S&P break this low here before I will switch back to a bear bias lah. But if the S&P is still like staying strong above this level, right, it is safer to go for a neutral approach. And we also have Franken. Unfortunately, the earning was quite bad, and then it dropped by 17% or what. But I think this is all right. This is all right because we do see some support buying coming in somewhere here, and then our stop loss is here lah. So I think this is still okay, mainly because of the fact that I think this one have probably dropped enough, and unlike most of the, in terms of technical structure, right, most of them is like a V-shape down, V-shape down, V-shape down lah. But at least here we have multiple support here, so we should be able to hold on to this position. And if you compare to other counters like for example, like Raffles Medical, like it is not like a V-shape up and then suddenly go back down, V-shape up, suddenly go back down. It does have a bit of like a multiple support before going back up. I think iFast recently also, okay, not so much yet. iFast not really so much yet, but it did have a bad earning here. It did have a very bad earning here, but it is managing to maintain this level here lah. So if it start to go back here, right, I mean the earning doesn't really gonna affect lah. So what you need to know about the earning is that earnings are a lagging indicator also. Earnings are backward looking. So for example, right, in the case of Franken, it says that profit dropped 18% due to expense rises, most likely inflation also, confirmed guarantee chop due to electronic technology, electronic component, right? But that is referring to all the past half a year lah, because Franken earnings come out every 6 months lah, okay, first half of the year. So what happened is that this is referring to the first half of 2022. But if let's say going forward, if let's say the inflation is not so much ready or what, then definitely the recovery can happen lah. So this one don't worry too much about it. I think the technical here is quite okay lah. Most likely it is going to probably retest somewhere here. For example, if it does not continue to recover, right, it will probably retest this level here. And I believe our stop loss is somewhere here. Initially, I wanted to go as low as here, but it is too much lah. I believe this bottom is a little bit too much. For example, yeah, it's about 21%. So if you want to go for such a wide stop loss, right, I don't want to have a TP all the way up there at 1.69 also. So yeah, I think around this level is fine lah. 1.13 is fine. The thing with Chip Ensing is that it's already like so far up already. You can actually like hope for another round. You can definitely play that, which means, right, if you want to play that, right, then your stop loss should be here lah, okay? Then your stop loss should be here. But wait, why my volume always disappear? So normally for Singapore counters, I tend to rely more on technical, mainly because it is due to due to how much lagging is the earnings are, right? You can't really do a lot of things. For example, if the earnings are going to come out half a year, right? Then I can't really make use of the earnings because it is too laggy already. But yeah, so let's come back to Chick Heng Seng, okay? So currently we are seeing a little bit of so-called volume exhaustion here, which can there are two ways to go about reading this. Number one is there's no buyer. Number two is there's no seller. So both can be true, because for every buyer, right, there has to be a seller. And unless that the buyer and seller match, right, then there wouldn't be any volume. So it can be a case where you have a lot of buyers that wants to buy, but nobody is selling. That's why the volume is low. Or you can have a situation where there's a lot of people that want to sell, but nobody is buying, and that's why the volume is low. So we can have these two situations that is going on. But because you are looking to, let's say if you are looking to long, right, then definitely you are hoping for the situation where there are no sellers, but there are a lot of buyers, okay? And if you kind of look at some of the candles here, you can see that yes, we have this big red candle with a big red volume, but this level is actually kind of like supported. So as long as the price doesn't go below this, right, you can see that somewhere here, right, there's a buyer support here, okay? Which is why it makes sense to put your stop loss here. But if you go in right now, what can happen is that maybe there are overwhelming seller that you don't really know, because we don't really know whether it is the seller more or the buyer more. And then if let's say the seller come, right, it can just break down here and eat, okay? So what you want is you probably want to wait for a breakout. You probably want to wait for a breakout, buy the breakout, and then put the stop loss there. But because this already at rally like 100%, right? It has already gone up like 100%. Okay, not 100, sorry, I exaggerated. 0.4 to 0.63. It has already rallied like 52%. And because, I mean, no matter what, it's a very big rally lah. So normally I wouldn't, like, I'm not saying it cannot go up some more. It definitely can, but I would rather put the money somewhere else lah. Yeah, I mean here I will say the same thing here also lah. But it did continue to rally. So I mean I wouldn't blame anyone if you want to go and catch here. So definitely can. I mean there is some risk, but you can definitely catch that. I mean it can end up like Samudera Shipping also, where we have a very big super duper rally that happened here. But the thing is, sometimes if too fast, it went up too high too fast, right? The backlash can be quite, I would say, quite painful quite painful. For example, this Nippei Craft is one of the penny counter that I was looking at previously, somewhere around here. And then I was wondering whether should I buy here or not, but thank God lah. And you might think that it's not a lot because of this big rally, and this little drop is not a lot. But if you get caught at the top, right, it is actually 26% down. It is quite a lot. So you have to be a little bit careful lah, if you are trying to chase something that went up so high. I'm also looking at Dynamax actually, but Dynamax shows a bit of those kind of problem where, like a slow death problem lah, slow death problem. Something like Fortress Mineral like that. Where's Fortress Mineral? this kind of slow death. And you can see that it kind of like have a like it is that beginning of that slow death. But another one that I'm kind of looking at is sadly we miss Jardine also. We actually miss Jardine also. I do remember talking about it here, but unfortunately we miss Jardine here. Where's the other one I was looking at? Sembcorp Industry. Sembcorp Industry also going higher and higher and higher. I think it is going to hit the all-time high level here. Yeah, but aside from that, I don't really see anything on the scanner lately also. Like for example, if you have you see Fortress Mineral like 7%, right? You may think that 7% is a lot because if you are not how should I put it? If you are not familiar with trading Singapore and US and what, right? For example, 7% in some of the US stock might seems a lot, mainly because of how certain like stocks works lah. Okay, so for Singapore, right, if you are above 20 cents, each pip is 0.005, so it contributes a lot to the percentage. Meaning for counters like Golden Agri, right? For counters like Golden Agri, where's Golden Agri? For counters like Golden Agri, right? Even if it move up by 1 pip, even if move from 0.275 to 0.280, right? The percentage move is actually quite a lot. The per pip percentage movement is quite a lot, mainly because it is very near the 20 cent level. So sometimes when you look at all these percentage increment, have to be very, very careful also, which is why let's say like First Resources going up 7% is quite, I would say, significant, because in order for First Resources to go up by 0.1, right, it actually requires 10 pips. But for Fortress Mineral to go up by that much, Fortress Mineral to go up by 0.25, it only requires 5 pips, which is like there's a 50% difference in pip movement lah, but you see the percentage movement is like roughly the same, so you have to be a little bit careful lah. And Nanofilm actually went up quite significantly today. Yesterday it wasn't the movement wasn't enough to show up on the scanner also. I think today it did not show up on the scanner also, but I know what's the reason it didn't show up. But one of my course member actually was looking at this, and then he was able to point this out. Okay, so for Nanofilm also, right, it is one of those bottom picking counters, which I believe like similar to Franken like that. So you can actually, if you don't have Franken, right, if you are in that YOLO state, right, you can actually go for this, mainly because you have a big red candle here, which is like a huge sell down like that. But after that, right, the price able to recover, and then it was able to follow it up with a good volume lah. So I think Nanofilm will fall into the category of a bottom picking counter also. But personally for me, since I already have Franken, I will not go for this lah, and I also have Spotify, so I'll probably not go for this also. But you can consider. So I mean, this one, obviously, if you are going for this, then your stop loss have to be below here lah. Okay, below here. If not, I think below there is too far off already. Actually, no, still can. You can go for below here, or maybe here, depending on how greedy you are. But I will say 1.9 is a good amount, and then you can like probably aim for maybe around 2.6 like that. It does fall quite low already lah. So this is more like I would say a YOLO play lah, okay? Because personally, right, why I prefer Franken is that at least Franken it kind of shows you that like yes, you have the bottom, but here at least there's another level of support coming in lah. So you have that confirmation of another support that is somewhere here. But if you are taking NanoFilm, right, you are actually taking the actual bottom there. You are actually going for this actual bottom here, and there is no sign of another sort of support level here. So the kind of play with this is that you are hoping for a very explosive move. You are hoping for that very explosive move, and you can actually see after yesterday, right, the first explosive move happened already, but you are hoping for another big explosive move. So what you want is that lah, okay? Personally, I would prefer the counter to go sideways like this, and then at least I know that okay, now this is supported. Also, there are consolidation. There's a consolidation. There's some buyers coming in, and then it can go up higher. Meaning what this is trying to show is that this is not explosive and then dump. It is not like that, because if you want to go for explosive and then dump, right, you have to make sure that you can monitor your trade. You can monitor your trade 24-hour 24/7 when the Singapore market is open, because if it does a explosive move and then dump, right, something like this, then if you miss that small window there, you are gone already lah, okay? That is why I don't really like to bottom pick pump and dump move, but I would rather prefer a little bit of safety, and then if this go up, right, then okay, I have confirmation of a additional buyer, additional support, then maybe this might be a really true bottom, and then I can catch that. So we can keep this in our watch list to see whether that consolidation happen or not. If that consolidation does not happen and it does this kind of like a pump and dump move, right, then I mean I'm glad that I'm not involved in that lah. Mainly because either you will end up buying here and then rally a bit, then you scared, you run with profit, then what's gonna happen is that the profit is not gonna worth your risk lah, okay? If you keep doing this many times, right, then your profit and your risk, they will eventually like cancel out each other lah, meaning it is not a consistent strategy lah. So I would rather let this trade go. Yeah, Franken gap down because of the we talk about this about like 10-15 minutes just now already. Let's go back and see what's okay. It's very resilient. You can see that it's extremely resilient. Let's see how's the trades are doing. Wow, plug power 3.96%. Spotify doing somewhat okay. So you can see I have a spot and plug also, sort of to see how the spread trade is like lah. Lululemon, unfortunately, Lululemon cut off already. Just to give you, wait, let me show you the update, okay? So this is my current open position. Plug spot Franken. Currently paper loss at 3.9. So as I was mentioning just now, right? Plug actually have it was a speculative play, like it was a earning play. In fact, when the earning came out, right, Plug actually dropped about 5% down. But because of the CPI, it just U-turn all the way back up lah. But it haven't hit the stop loss yet lah. Okay, so if I this one example if I combine this floating, right, it is about 2.3K lah. Okay, 2.3K loss there. So it is still like if I were to take the risk of these two trades together, it is still quite far beyond the risk of $4,000. But I think in this situation, right, I will probably sort of treat these two trades separately lah, mainly because plug power is already ahead by -2,000 when I put on the Spotify trade. But let's look at the close position recently one. Lululemon 1.8 cut. Then Tyson 1.7, not a lot also, but barely even out lah. So we do see we do see quite a bit of volatility in the oil prices also, which is it is like don't want to break up above the $100 here like that. But this one we continue to monitor lah. Okay, this one we continue to monitor. But one thing I want to point your attention to is to the US dollar. US dollar actually the last few days it gap down lah. On the CPI day it gap down because when the CPI data came out, right, it kind of like US dollar kind of assumed that okay, no more rate hike. The market assumed that okay, there will be no more rate hike. So the dollar went down by a bit, but right now it is recovering back also. So it is showing very how should I put it? A lot of contradictory data, even for the yields, right? You can see that on the day that CPI data came out, it went all the way down. And then if it decide to go down some more, right? Then we have two, how should I put it? We have both bond yield and the stock market aligned together to say that okay, most likely no more rate hike already, but then the yield kind of bounced back up, and then it is now back to like before the CPI data level and somewhere around the NFP data level also, which is kind of like it's a very contradictory data, and which is why, right, I don't have the conviction or the confidence to have like a full short or a full long position, or slightly more biased toward either side lah. And even for the 10-year yield, right? Even for the 10-year, it is actually going up. It's like on the CPI day it went down, but now it went higher. It went higher. It went higher compared to the CPI data day lah. So normally when you have the yields going up, right, it is an indication that like the market expect the interest rate to go up in the future lah, in the near future lah. Like even for the yield curve also initially it went back up, and then there were a lot of talk about okay, like the yield curve gonna steepen a bit, gonna relieve the pressure, but now it is coming back down again. So like is a big question mark. If we have everything aligned together, right, it is much easier to make a more conviction trade lah. Home Depot. Okay, for Home Depot, right? I personally have option position on this. I'm holding onto my option position also lah. But if you want to cut, right? If you want to cut now, I don't blame you. Yeah, next week. Yes, correct. Next week is earning. If you're scared of the earning, right, then you can definitely cut first lah. If you're scared of the earning, you can cut first. But I'm holding through the earnings also lah. And I mean, whether to cut or not, as mentioned earlier, right, is truly depend on what is your current exposure, what is your current risk right now. Yes, I mean, no matter what, we don't want to lose money lah. But if what you are holding right now is like way beyond your exposure, right, then yes, I think you can cut before the earnings come out lah. But personally, I'm still holding on to my options, and as long as the price is below here, right, below this candle here, I think you can continue to hold. But what you mentioned, there's earnings, so there is a gap risk lah. There is a gap risk. So if you are uncomfortable holding, right, then yes, you can cut. So I'm coming from the risk perspective. Okay, I'm not coming from this one can go up or this one can go down. The reason why I'm still holding is because I think this one can go down lah, and I am comfortable with my risk, so I am still holding. But if you are overexposed and you are scared of the earning, then you definitely should cut lah. But it's because you are uncomfortable with your risk. It's not because okay, this one definitely 100% chung up. It's two different things lah. Okay, so yeah. And Apple is Apple is truly crazy. I can tell you this kind of price action is truly crazy. We have 1, 2, 3, 4, 5, 6, 6 weekly green candle, and the thing is that like I mean from looking back at the earnings, right? It's not a very good earning, and I'm very convinced. I'm extremely convinced that this one is just too much already, and soon, right? I think soon, it should come back down lah. It should come back down, and it should come back down quite substantially. And but I mean that's just what my view is. Whether or not I want to make an actionable trade on that view is another question now. Okay, I think if I were to make this trade, right, I will probably make it privately lah. I won't I will not post it as a actual trade setup lah, because I will say that it is too much speculative. It's not following anything. It's not following any analysis at all. It is just a gut feeling that okay, the earnings are bad, and then they even with the bad earning, they say they can maintain their Q3 target, and they just say that they can maintain their Q3 target, but they never say what their target was during the webcast. I think the exact word that Tim Cook say was they expect growth to accelerate during Q3. And he just say that, like, just say he expect growth to accelerate, but he didn't give a guidance number. So normally, like companies like Amazon, they did give their guidance number, but for Apple, they didn't really give their guidance number. And for cases like Amazon, right? Like I would say Amazon rally is not so surprising. In fact, their sale was slightly better than Apple. They did make a loss, but the reason why they make a loss is because they have to impair their loss on Rivian, which is what everybody knows already. But aside from that, most of their stuff were looking quite okay. But for Apple, right, the the sales actually went down. The sales actually went down, but it's like it's acting like a growth counter lah. It is acting like one of those Cathy Wolf growth counter lah. So this one, if I were to like play a YOLO shot, right? In fact, I think I have told you guys before. In fact, on their earnings, right, I made a very small put position about $500, and then next day earning come out, that $500 become zero, like on the spot lah. But I mean, it was a very small YOLO trade lah. But I think somewhere around here, the first weekly red candle that I see, like this, the first weekly red candle that I see, I will most likely go for a very small put option again. It is those kind of trades that maybe I will make like another $500 put option. But if it goes all the way down, right, this $500 can become $5,000 lah. That's how option works lah. So for those who are in Plug Power, right, plus 4% really. For those who are in Plug Power, right, like for example, if you have the option, right, most likely your option is down 80-90% already lah. Given how this kind of price action that you are seeing, and that is the nature of option itself, which is why when you buy option, right, your risk is your entire option. But the thing is that even though if it's down 80-90%, right, if let's say in the next 1 week or 2 weeks, I think the option expiry I've given you is next month now. Okay, it was. Wait, let me check. Yeah. I mean, yes, Apple have a $90 billion buyback plan, but I mean, if something really too much, it will definitely come down. You can't expect to say $90 billion plan and then expect this whole thing to move up straight away like that, because they also have buyback plan here. They also have buyback. They also have all the buyback plan here. Yeah, so I mean, the buyback plan is already embedded within the stock price action. Where shit, where was Block Power? Yeah, September 16. Okay. So for example, right, let's say if you are holding onto that option, and if your option is down like 80%, right? For example, if I play $1,000, if I risk $1,000 on my option, meaning my entire option contract is $1,000, this will probably bring down your option value by 80%, meaning your $1,000 option now only have $200 now. So the worst thing you can do now is to go and like sell your option, sell your option for $2,000 and then take the $800 loss, mainly because firstly, your risk is your option contract. You shouldn't be doing that. But if let's say by the next 1 month, right? If let's say by the next 1 month, if this whole thing is going like if things are quite bad and then this whole thing crash for some reason, right? And then you are going to see this drop as big as that, right? What can happen is that your that $200, right, suddenly can become like $3,000, $4,000, something like that. That is the big explosive move of option also. Okay. So and because it is an option contract, right? You don't really need to care about stop loss. It doesn't matter this one go up here, where, because at worst, right, your $1,000 option, it will go to zero. Meaning like, let's say by the time the option expire, right, then your $1,000 will become zero, okay? So that is why your entire option contract is your risk. But the thing is that if currently right now your option is already down by 80%, right, then I mean, you are supposed to hold your option contract like to all the way from the beginning. So I would rather not take the $200 where there's a chance that in the next 1 month, this $200 can probably become like $2,000 or $3,000 if let's say the stock contract, mainly because once again, Plug Power is one of those companies that not really making money at all. In fact, they are making even more losses, but it is just rallying based on like a broad market, I would say, a broad market rally. So if you have no experience in options, right? What I suggest is you can read up first. You can go and read up the basic stuff first, but you can also play those very small one, small one as in, like for example, Plug Power option was probably $200 like that, $200 like that. So you can play those very small options to just see look lah. When I started trying to play like very basic option, I read like a few websites, and then after that I go and read a lot of YouTube videos, this and that. But the only way I managed to grasp the nature of options is when I actually buy the option. I actually play the option. It's like, okay, I'll just buy and see what happens. So I bought like $300 worth of option on a penny counters lah. I forgot what was the counter, but it was those like very cheap counters where the option only cost like $1 like that. $1 or even less than $1, and one option contract is 100 shares lah. Okay, so if the option contract costs $1, then you have to pay $100 lah, because you have to multiply by 100. I think it was Rivian, if I'm not wrong. Rivian was the one of the first few trade that I played options. I think back then Rivian was like somewhere here. Yeah, I think it was Rivian $60. But the option contracts was quite cheap. Let's see what else is. I think right now we should look at what are the red one, so that we can pick out the outlier. Zim is red. Holo minus Holo minus the bad earnings. Walt Disney, Novavax went down a lot during the earnings also. How WWE doing? Personally, I will hold lah. Personally, I will hold. Like once again, right? With the Home Depot, using the Home Depot as a example, also when you ask me whether to cut or not, I cannot tell you whether okay cut because I think this one confirm hit. I cannot predict it's going to go up and then you cut right now, because who knows, it can come back down like that also. So if you ask me to whether to cut prematurely or hitting stop loss or not, right? The only thing I can tell you is like, can you handle the risk or not? So whether you want to prematurely run is depend on whether can you handle the risk or not. If you cannot handle the risk, you run first. If you can handle, then you hold lah. So like I cannot tell you, because if I can predict this one go up and cut, right? Then of course I will tell everyone to cut already lah. And of course my stop loss wouldn't be there in the first place lah. My stop loss will be here already lah, because the moment it hit I will run already lah. Okay, so if you ask me like what I think about a counter when nearing the stop loss, right? Yes, everyone want to exit by losing less money, but the thing is that the stop loss was there for a specific reason in the first place lah. So the action of whether you should cut or not should be coming from a risk perspective, not whether this one can go up or go down or not. Okay, but I mean this counter, this trade initially itself is a earning play lah. Okay, earning play in a sense that it was supposed to be like Tyson food, where the earning came out quite bad and then it got down and then we take the profit and run lah. But now it is going up a bit. Okay, it's not a bit. It went up quite substantially, but it is still below the stop loss, meaning which means to say that it is still within your risk. It is still within your risk, and because the earning is over already, right? You do not have the same risk as Home Depot lah, where Home Depot, because the earning haven't come yet, right? You do risk a earning gap up lah. But in this case, this earning already happened, right? You are probably not going to risk another gap up, which means to say that you can probably hold until like it hit the stop loss lah. It is still $1 away, and we have some selling pressure that is happening here. So perhaps as long as like it doesn't go above here, you can still continue to hold because there are some selling pressure here. But I mean, if you want to cut above here, right, that is already very near $30 lah. So the reason why the stop loss is there, because previously we have selling pressure here also, among other stuff lah. Okay, so if you want to cut, you can cut if you cannot take the risk. But if you cannot take the risk, right, then you should look back previously. Like before you enter, you should look back when, okay, number one, why did you take this speculative trade? And number two, did you over, like, is your lot sizing way bigger than what you could have risked? So those are the kind of the question you can look at lah. It is very hard to, like, the moment price goes against your direction, then you start making prediction to cut early. just to sort of just to like take lesser losses. Because if you keep doing that, right, if you keep doing that consistently, right, what's gonna happen is that you're gonna miss a lot of profitable trades where, like, let's say you short here, imagine you short here, and then the stop loss is here, and then it goes up a bit, you cut, then the whole thing go down. Then what's gonna happen is like you took a loss when you could have taken a profit. So for example, let's say your risk is, let's say you short here, your stop loss is here, you risk $350. Let's say okay, let's say you risk $350, and then your TP is here, your TP is $600. Example, okay? So now price goes up a bit, you are down by $150. So it's because you don't want to lose 250 for some reason, even though initially you already know that that's your risk, you don't want to lose 350. You decide to cut first, you cut the 150. So you cut your position here, $150. Okay. So you take the $150 loss, and then you feel very happy. Oh my God, I only lose 150 instead of 350. So you think you are up by $200 because now you save $200. But what happened is that, what if price go up and then it start to go back down and hit your profit? So what happened is you lost 150, but you also lost $600. In total, you lost $750 because you are unwilling to take that $350 risk. So this is the kind of thing that you need to be careful. The purpose of stop loss is that it gives you the margin of error where you don't know it's gonna go down like this, like this, like this, like this, like this. So that's why the stop loss is there, is to give you that margin of error. So if you go and like look at your trade journal, right? If you go and look at your trade journal, that $750 loss is not going to show up in your trade journal. There's no way you can do any analysis. What's going to show up in your trade journal is $150 loss. And then you look at this $150 loss and you'll be very happy. Oh yay, that one time I only lose $150. All my losses are $350. But the thing is that trade journal is unable to show missed profit, or worse yet, if they are unable to show losses that could have been profits. And most of the time when trader cut ready, right, they don't really come back and look at the chart also to see whether their original stop loss level was correct, their TP level was correct. Hardly most trader will do this kind of homework like to look back at all their trading losses which is right. Once I put my risk and stop loss, right, I don't really tamper with it so much. I just leave it there unless for some reason I overexpose myself, or I got too many shots for some reason I got too excited and then put too many shots there, then yes, then most likely I might cut one or two there. But I cut is because I want to reduce my risk, not because I think they are going against my direction or what. So you have to be very careful. Like for me trading, right, I will always track the stocks where I hit the stop loss, and then it just U-turn and hit the TP. For example, right, it hit the stop loss and then it just U-turn and hit the TP. I will usually track the number of times where I encounter this kind of trades And usually, right, if I keep encountering this kind of trade very often, right, it means that the stop loss level is something wrong with the stop loss level. It's either my stop loss need to be wider, or my entry a bit star. So I will keep track of all this, and so far this year still quite okay. I believe there are a few trades, but not a lot. Some of them are still moving, like for example, I think Cortera. Sorry, not Cortera, my bad. Cheniere Energy. So we enter here and then it hit the stop loss and then now it's going back up. So I think Cheniere Energy is one of them. Chevron is another one. I think it's all the energy counter. The short was entered here, and then after that, it hit the loss and then it came down here lah. So far for this year, I think there were Nvidia. Let's look at Nvidia. Okay, I think and Nvidia failure to take over it was like very long time back already lah. It was quite a long time back already. Okay, so Nvidia, this kind of counter, right? It is those counters that, I mean, when you talk about long term, it is like how long term is long term lah. Like how long are you looking at? If you are looking at 10 years, 20 years, or okay, let's not go 20 years lah. I think if you look at okay, 5-10 years. If you look at 5-10 years, right? I think that this is still okay. It is still okay, provided that you are able to do dollar cost averaging lah. Okay. So for example, let's say you have $20,000, you have a $20,000 portfolio, and then you put your entire $20,000 here, and you are hoping that this one will recover there, right? Then the one a bit hard lah, a bit hard, because now what's gonna happen is, yes, it can come back there probably in the next 5 to 10 years, or even in the next 5 years, it can probably go back there lah. But the thing is that you are going to wait 5 years to just break even lah. Okay, but let's say if you have a proper investment plan, like for example, right, I have a dollar cost average portfolio on STI lah. Okay, I think this is something that I shared previously also. Every month I will dollar cost average is part of my investment plan, which is totally different from my trading now. Okay, but if you were to like do a proper dollar cost average or what, or I mean, it's impossible to do dollar cost average on a single counter lah. But I think at most you can do is buy by batches law, buy by batches, and then I think eventually, right, if it does go back up, and if you have a proper DCA, right, I think eventually in the next 10 years, even if it just go to 400, right, I think this is still fine. But of course, in the next 10 years, I think this one can go a lot higher lah. So far in terms of the business perspective and the fundamental perspective, why, right, it is diving right now due to a few reasons. Number one is you can blame the crypto bros lah. Okay, the crypto bros went overboard, and then the demand for Nvidia is just gone lah. Secondly is also mainly due to interest rate lah. I think interest rate is a bigger, I would say the bigger contributor here. But the moment what market recovers, right, when the hike actually stops and the easing come, and like the crypto people got their shits together, right, plus all the future EV lah, all the metaverse stuff, they are more concrete, right? Because right now everything is still like on a very I would say theoretical level lah. No one knows how the metaverse is going to get monetized. No one really knows how how the in the future all these EV like how are they going to like sort of improve on their hardware also. So there is still huge growth for Nvidia here. It is just that now is kind of like deleveraging a bit, which is a good opportunity to do some batch buying now. Okay, batch buying. So normally how I do batch buying is that, for example, let's say if I want to batch buy Nvidia, right, maybe I will set aside the money first. For example, I have 10K that I want to batch buy. So once I have that 10K, right, I'll probably do like a 3K here, 3K here, 3K here. And then after that, that's it. So what you do not want to do is, you do not want to like go and put all your money here, and then when it drops some more, right, you have to go and dig additional money out from don't know where just to average down some more. So now it's a different situation because you are averaging down without a plan, but rather you should properly plan it out, and then eventually if it can it will recover and you'll be able to sort of like reap the reward . Fundamental side definitely is fine. Fundamental side is fine because now we have that chip act that's coming in. I don't know if NVIDIA will benefit a lot, but definitely there will be a lot of benefit to companies like Intel and Micron. But for NVIDIA, right, the usage of their product, right, it will definitely extend beyond crypto and gaming also lah. So there is a big opportunity out there for the usage of NVIDIA product. It is just that currently right now, of course, when the price drop by this much, you will start to question the fundamental, but you do have to be clear of what is causing this drop in the first place. And as mentioned, right, there are two causes lah. One is all the crypto bros. The other one is the interest rate. Both are very sensitive to, both of which NVIDIA is quite sensitive to lah. So overall, right, our LUM NVIDIA together with companies like Microsoft like that, they are definitely long-term future. It is good, but unlike Microsoft, NVIDIA is slightly more leveraged based on their balance sheet. So they are more sensitive to interest rate and whatever the current market condition is lah. Yeah, no worry, no worry. Lemonade is very strong though. Already breaking up. Kind of like hanging around there. Kind of like still hanging around there. I'm just gonna set my alert here. I got so many alert on the downside, and if one day I have a string of alert coming up from my email, right? I know what's happening. Like it is on the downside. If I only get one alert, then it is on the upside here. We do have the 30-year mortgage going back up by quite a bit. Initially from 4.97 went to 5.22. Mainly because the bond recovers lah. The 30-year also went up quite substantially. Gold is I'm a little bit surprised that given this big drop in US, right, gold kind of like a little bit muted here. I was expecting it to like go up a lot higher. So currently, right? Sorry, just now I was here. Just now I was here and then lost track. Okay, yeah. So I got Franken plug and spot. So it's like two long and one short. Okay, but unfortunately, plug due to the gap up, it is showing a big number here, but never mind. I will just let it be. So currently, two long and one short. So I'm sure some of you still have Home Depot. So as I mentioned to Megan just now, right, whether you want to hold on to Home Depot or not is truly dependent on your risk lah. But I think it is quite important. Megan point out that the earning is coming up on the 16th of June, which is next Tuesday. So if you are afraid of the earnings, right, you can definitely exit first. You can definitely exit first. So let's say if you don't have Plug Power, but you have Home Depot, right, you can actually like pair up Plug Power with Home Depot also. I think that's a good pairing also. But suppose, right, suppose you feel that you want to exit first because of the earning, you can exit first. But let's say once the earning come out, if it does a big gap down, then whether or not you want to re-enter is up to you lah. Whether or not you want to re-enter is up to you also. Although I want to say that considering this big rally here, even if the earning is like quite good, I think this rally itself is already like how should I put it? It's already too much lah. Meaning the earning have to be very, very good to the point that it can create a gap up lah. For example, if let's say Home Depot is somewhere like at this level, right? Then yes, then I would think that earning came out to be very good. It can gap up like 10% like that. But because it is already here, so I feel a little bit how should I put it? I something inside me thinks that the earning shouldn't cause a very big gap up lah. It might be able to cause a big gap up, but not above 325 lah. Okay, not above that 325 level. I'm a little bit hesitant also because previously I believe that Apple shouldn't cause a very big gap up, but I mean it did have a gap up, but it wasn't a very big gap up where I mean we don't have trades on Apple lah. Okay, we don't have trades on Apple. So for example, if I short here and my stop loss is above here, right? At least I mean this kind of it was a 3% gap up lah. It didn't get all the way above the stop loss lah. And in fact, I mean if it continue to go up, then you are still able to take out your loss lah. So even if this one have a big gap up, right, I don't think it will go above 325 because I think the original one is at 325. Yeah, it was at 325. So no fast answer. There's no fast answer. So this one is really a DYODD lah. AMD still going up. Amazon flat a bit. Apple is really crazy. Apple is really crazy. I think Apple is the only thing that holding up S&P, Nasdaq, and Berkshire. I think Berkshire rally all the way is also due to Apple. The other day I was looking at a YouTube video where this guy was comparing Michael Burry and Warren Buffett lah, and the way they trade lah, or the way they invest lah. I mean they have some similarity, but one of the biggest difference was Warren Buffett. He made a very good observation where Warren Buffett compared to previously, right? Right now his portfolio have so much weightage on Apple that his portfolio is no different from S&P 500 lah. Because S&P 500 have a 7% weightage on Apple, considering that there are 500 companies and Apple alone is like 7% weightage already. I think Berkshire have even higher weightage on Apple compared to S&P 500. Recover quite well. Ring Central. Let's go and look at the even even the cruise are shooting all the way back up. Disney, Norwegian Cruise. Charter, Comcast, Dish, Paramount. Whirlpool is the one that is still on my shorting list, but even though this counter look relatively weak compared to the rest of the consumer discretionary, right? But because the market is so bullish, I'll probably hold this one out for a while. We do have this big drop here. But after that it went back up. But let's say if this one continue to like go sideways, then perhaps it is an opportunity that they give us a price to short higher lah. Okay. So there are a lot of counters that are going up like for no reason, which I mean, if you put it in the current context, they are opportunity to short higher, but because the market is so irrational, right? You don't really want to short right now because as they say, market can remain irrational longer than you can remain liquid lah. Caterpillar also is doing quite okay. Well, yeah, let's look at the heat map. I think visual representation is much better. J&J, AbbVie, Exxon, Chevron. Apple already at 1.2. Apple already at 1.22. I don't really want to look at Wall Street bets right now, mainly because it's filled with Bed Bath and Beyond. It's like very annoying. It's very, very annoying. Like everything is Bed Bath and Beyond. BBBY. Short seller pre-market. True though. BBBY. See, every single post is about BBBY. Like after the short squeeze happened, right? Like all the technical and fundamental analysts will come out explaining why. But the thing is that I think this kind of short squeeze that there's no fundamental or technical that makes sense lah. I think even for GameStop, right? Like all the technical and fundamental are just thrown right out of the window lah. BBPY. What is DDDY? Oh, sorry, I think it's referring to the. Never mind. I just got the joke. BBBY. Okay. How's BBBY doing right now? So I think I mentioned it before. There was someone who go and bought Best Buy instead of Bed Bath and Beyond because Best Buy was BBY. But that guy made money anyway because it still went up lah. Hey, impressive though. Like all the donkeys who held here, they are actually in profit. How much was this rally? 73%, 100%. Tyson Food recovery. Excuse me. BBBY. I think even here probably a lot of put to call ratio is still favoring put. So far up 20% for the year, thanks to addition of BBBY. Oh yeah, Elon Musk actually sold his shares at 869. It's very funny, right? Well, he always managed to catch the top, you know. He always managed to catch the top. It's like this round he sold somewhere here. I think previously he sold somewhere here. Upstart holding is okay. Yeah, yeah, yeah. Actually, I got it the other way around. Not really though. Not really though. I mean here. Like, will you short here? I mean, I wouldn't short here lah. It's quite scary to short here. Stop split coming though. Like even for Twitter, right? If you look at Twitter, where's Twitter? TWIT. Shit, I forgot when did all the nonsense happen. Was wait, when did Elon Musk buy Twitter? Did Elon Musk buy Twitter? Shit, I forgot when he buy Twitter. Yeah, let me Google. 25th April is when he made the deal. But when did Elon accumulate Twitter share? Okay, cannot find. I will find tomorrow. I forgot the actual date that he bought. But the funny thing was when he was buying, right? When he was secretly buying Twitter, it was actually going down. But it shoots up when the news that he bought Twitter is made public. But when he was actually buying, it wasn't going up, it was actually coming down. So it's kind of like very very funny because Twitter went up because a lot of people heard that Elon Musk was buying, but when he was actually buying, right, like it's not going up at all. So the amount of like the speculation that is taking place is crazy lah. It's crazy. What's the oh, it's actually 11:10. Okay guys, so that's it for today. So hopefully, right, we will be able to sort of have more, how should I put it, we don't really want to get too over aggressive with the long side on the short side lah. So when we are in this kind of situation, right, where we just suffered a bit of a drawdown, then after suffering from drawdown, right, the recovery process is quite important also, because you don't just want to start blindly switching your position 180, or you do not want to remain extremely dogmatic in your view where you still die want to short. Like both way are actually the wrong way to go about it lah. But rather, right, we want to sit back and then like look at the situation and then try to plan properly on how to go about with our trade plan lah. Mainly because, right, if you already suffer a drawdown and then after that you go about things the wrong way, then you're gonna suffer another drawdown again, which is like like two big drawdown in a row is a very bad situation to be in. Okay, so right now we remain uh very light in the sense that we don't want to add too many trades. We have like two shots too long. If plug power got hit, then that one, I mean, it was a earning speculation. So if it hits, then let it hit. But going forward, right, we will see how to manage the situation now. Okay, we will see what are the long and what are the shorts that we should go for lah. Okay, guys, so we will meet again tomorrow. Oh, I have actually messaged all those who were getting the $100 voucher. So if you have not received my message, right, please go ahead and look at your Facebook, because sometimes Facebook, right, you have to actually there's this little corner where if I am not your friend, right, you will not immediately get my message. It will tell you that someone is trying to message you or whatever lah. Okay, so please do go and check, and we will go through more structured stuff tomorrow lah. Okay, guys, have a good night. Good night.